In less than 4 weeks, the European economy went from the edge of recovery to the edge of collapse. That is not a metaphor. That is the data released this morning, March 24, 2026. France, the second largest economy in the Eurozone, has officially contracted for 3 consecutive months. That is the clinical definition of a recession, not approaching recession in one. Germany, the largest economy in Europe, the industrial engine that has powered the entire continent for 80 years, flatlined this month, manufacturing output barely breathing, consumer demand evaporating, companies cutting production before the supply chain disruptions get worse. The Eurozone Composite PMI, the single most reliable barometer of whether Europe's private sector is growing or shrinking, just hit a 10-month low, 50.5, a hair above the 50 threshold that separates expansion from contraction, one bad month away from the whole reading going negative. The ECB held rates at 2% last week. It had to, but it also revised its 2026 inflation forecast upward to 2.6% while slashing its growth projection to 0.9%. The central bank of the world's largest economic bloc just officially told you, we expect almost no growth and inflation above target simultaneously. That is stagflation, not the fear of stagflation, not the possibility of stagflation. Stagflation documented, confirmed by the ECB itself in an official policy statement. And here is what nobody is telling you. This is not about the Iran war. The Iran war is the trigger. The stagflation trap Europe just fell into was built over 40 years of decisions that made this outcome. When any significant energy shock arrived, mathematically inevitable, this exact scenario was predicted. The data was public. The pattern was documented. The experts who warned about it were dismissed as alarmists. They were not alarmists. They were reading the pattern correctly. Because this exact sequence, energy dependency, external shock, stagflation trap, ECB paralysis, political crisis has happened to Europe before, not once, 3 times in the last century, and every single time the people living inside it said the same thing, that this time was different, that their institutions were strong enough, that they would find a way through. They were wrong every single time, and you are watching it happen again right now, today. If you think what is happening in Europe does not affect you, if you think this is someone else's problem, something you can scroll past, something that stays on that side of the Atlantic, you are about to find out how wrong that assumption is. Because Europe is the United States' largest trading partner, because the dollar's strength is measured partly against the euro, because the financial institutions that hold European sovereign debt are the same institutions that hold your pension, your 401,000, your bank deposits, because the German industrial companies that are currently shutting down production lines make the components that go into supply chains that eventually reach your stores. This is not a European story, this is a global story, and the pattern underneath it is one of the most important and most consistently ignored patterns in modern economic history. Give me 20 minutes. By the end of this video, you will understand exactly how Europe trapped itself, why the ECB cannot save it, and what history says happens next. Let's go. Right now, Europe imports approximately 57% of its total energy. That number is not new. It has been building for decades. But what changed in March 2026 is who that energy was supposed to come from and what happened to that supply chain. Before the Ukraine war in 2022, 40% of Europe's natural gas came from Russia. When that supply was cut, Europe scrambled. It bought American LNG, it bought Qatari LNG, it signed emergency agreements with Norwegian producers. It paid whatever price the market demanded because the alternative cold homes shuttered. Factories, political collapse was worse. That emergency reshuffling worked barely at enormous cost. European energy prices in 2022 and 2023 were 3 to 5 times higher than American prices. German industrial companies, the companies that had powered Europe's export dominance for a century, began relocating production to the United States and Asia. Where energy was cheaper, Europe survived, but it did not fix the underlying problem. It traded dependence on Russian pipeline gas for dependence on LNG shipped through global supply chains that ran critically through the Strait of Hormuz. Qatar is the world's largest LNG exporter. The overwhelming majority of that LNG, including the supply that now heats European homes and powers European factories, loads from Qatari terminals in the Persian Gulf and transits through the Strait of Hormuz to reach global markets. On March 4, 2026, Iran declared the strait unsafe for navigation. Tanker traffic fell 95% within days. 200 million barrels of oil and billions of cubic meters of Qatari LNG sat stranded, unable to reach buyers in Asia, unable to reach buyers in Europe. Europe's energy emergency of 2022 had not ended. It had paused, and now it had resumed at a moment when European strategic reserves were lower, European industrial competitiveness was already damaged, and European political systems were under unprecedented pressure from a decade of economic stress. The IEA called it the most significant threat to global energy security since the 1970s oil shocks. They are right, and the 1970s oil shocks are exactly the historical parallel you need to understand, because the 1970s did not just cause a recession. They caused a decade of stagflation that destroyed an entire generation of European middle-class wealth, and the pattern that produced that outcome is the same pattern that is active right now. This is what I call the energy dependency trap, for stages, always in the same order, always producing the same outcome when a dominant external shock arrives. Stage 1 is the structural dependency phase. An economy or a block of economies prioritizes cheap external energy over domestic energy security, not because they are stupid, because it is rational in the short term. Imported energy is cheaper than domestic alternatives. It allows manufacturing competitiveness. It allows lower consumer energy bills. It allows governments to avoid the political cost of investing in domestic alternatives. The dependency builds gradually over decades in thousands of individually rational decisions that collectively create a structural vulnerability that no single actor is responsible for and no single actor can fix. Stage 2 is the false security phase. The dependency has become so embedded in the economic structure that reversing it would itself be enormously costly. But nothing has gone wrong yet. Prices are manageable. Supply is reliable. The experts who warn about vulnerability are answered with statistics about strategic reserves and supply. Diversification and the mutual economic interest of suppliers who need the export revenue as much as importers need the supply. The warnings are filed away. The dependency deepens. Stage 3 is the shock. An external event, a war, an embargo, a revolution, a regime decision disrupts the supply that the entire economic structure was built on. It does not need to be a complete cutoff. A significant reduction is enough, because the economy has no slack. The dependency is so complete that any meaningful supply reduction immediately translates into price spikes that cascade through every cost structure in every sector simultaneously. Energy is not just an input, it is the input that makes every other input possible. When it becomes scarce and expensive, everything becomes scarce and expensive. Stage 4 is the stagflation trap. This is the moment that breaks central banks. The energy shock drives inflation upward, prices rising because supply is constrained, not because demand is excessive. At exactly the same time, the energy shock drives growth downward because high energy costs crush corporate margins, reduce consumer purchasing power, and force companies to cut production and investment. The central bank now faces an impossible choice: raise rates to fight inflation and risk pushing an already slowing economy into deep recession, hold rates or cut them to support growth and risk losing control of inflation expectations, which could produce a wage price spiral that entrenches inflation for years. There is no good option. Both paths lead somewhere painful, and the longer the external shock persists, the worse both options become. Four stages, the energy dependency trap, let me prove it. The year is 1973. The Organization of Arab Petroleum Exporting Countries announces an oil embargo against the United States and Western Europe in response to support for Israel in the Yom Kippur War. European nations, deeply dependent on Middle Eastern oil, immediately face the full force of Stage 3. Oil prices quadruple in 3 months, from $3 per barrel to $12. The European economies of 1973 had none of the inflation-fighting institutional credibility they would develop over the following decades. Central banks in Germany, France, the United Kingdom, and Italy faced exactly the stagflation trap described in Stage 4, raise rates to fight oil-driven inflation and crash already slowing economies, or accept inflation and watch it compound. Most European central banks chose to accommodate the inflation initially. The result was a decade of stagflation. Annual inflation in the United Kingdom reached 25% by 1975. Italy experienced a near sovereign debt crisis. France's economy contracted for multiple consecutive quarters. Germany, with its historical memory of Weimar hyperinflation, tightened aggressively and experienced its deepest post-war recession to that point. The pattern held across every variation of policy response. The economies that tightened experienced deep recessions. The economies that accommodated experienced prolonged inflation. None of them avoided severe damage because the damage was structural. The dependency had been built over decades. It could not be unwound by a policy decision over months. The wealth destruction was generational, not just in asset prices, though equity markets across Europe fell 40–60% from peak to trough during the stagflation period, in purchasing power, in savings, in the real value of everything denominated in currencies that were being inflated to manage the external shock. An Italian who held their savings in lira in 1973 and held them through 1983 had lost more than 60% of their purchasing power in real terms, not because they made bad investment decisions, because they were inside a system that had built a structural dependency they had no individual power to escape. Check, verified, undeniable. The year is 1979. The Iranian Revolution removes approximately 4% of global oil supply from the market. Europe, which had rebuilt its economies through the late 1970s on the assumption that the 1973 shock was a one-time political event rather than a warning about structural dependency, is hit again. The United Kingdom, in the middle of its deepest labor conflict since the general strike of 1926, faces oil-driven inflation on top of wage-push inflation on top of a pound in structural decline. Margaret Thatcher takes power in May 1979 and implements the most aggressive monetary tightening in British post-war history. Interest rates rise to 17%. Unemployment doubles to over 3 million, levels not seen since the 1930s. Industrial output collapses. An entire generation of British manufacturing, already weakened by the 1973 shock, is effectively ended. The dependency on external energy combined with the external shock did not just cause a recession. It caused a permanent deindustrialization of the British economy that restructured the country's class system, its geography, and its politics in ways that are still visible today. In France, the government of Giscard d'Estaing responded to the 1979 shock with a massive nuclear power program, the most aggressive domestic energy build-out in European history. By the late 1980s, France generated 70% of its electricity from nuclear power, the highest proportion of any major economy. France essentially solved its structural dependency at enormous cost over more than a decade as a national emergency. The lesson France learned in 1979, that structural energy dependency must be eliminated, not managed, is the lesson the rest of Europe did not learn and is now paying for. Check, verified, undeniable. The year is 2022. Russia invades Ukraine. European nations that had deepened their dependence on Russian pipeline gas through 2 decades of decisions justified by economic rationality and assumptions about mutual interdependence discover that mutual interdependence does not survive a war. German industry, the most energy-intensive major manufacturing sector in Europe, faces gas prices that rise by 500% within months. BASF, the largest chemical company in the world, announces production cuts and the partial relocation of operations outside Europe. Volkswagen announces it is reviewing the competitiveness of its German manufacturing operations. The Federation of German Industries publishes reports describing the potential deindustrialization of Germany as a structural risk, not a theoretical one. The ECB, which had been buying time with negative interest rates and quantitative easing for a decade, faces inflation that reaches 10% in the Eurozone in late 2022. It is forced into the most aggressive rate hiking cycle in its 23-year history. European economies that had built entire sectors on the assumption of near zero interest rates, commercial real estate, leveraged corporate debt, government bond markets face severe stress. Europe survives 2022 and 2023 barely, with enormous pain, with permanent structural damage to its manufacturing competitiveness, without fixing the underlying dependency, simply trading one form of it for another. And in March 2026, Stage 3 arrives again for the third time in 50 years. Check. Verified, undeniable. Now let me tell you what happens next, because the pattern is specific, the precedents are documented, and the outcome, absent a rapid resolution of the Strait of Hormuz crisis, is more predictable than most commentators are willing to say out loud. The ECB is already in the stagflation trap. Christine Lagarde said so last week without using those exact words. 2.6% inflation forecast, 0.9% growth forecast, no room to cut without risking inflation entrenchment, no room to hold without risking recession deepening. Here is the specific mechanism of how the trap tightens over the next 90 days. European companies operating in energy-intensive sectors, chemicals, steel, automotive glass, ceramics, are already cutting production, not planning to cutting. Volkswagen's production schedule has been revised downward. BASF has announced temporary facility closures. These are not speculative risks. These are current events reported this week. When production cuts happen, two things follow simultaneously. Corporate earnings fall because output falls while costs remain high, and unemployment rises because companies cutting production cut workers. Both of these events happening at the same time make the ECB's position worse. Falling earnings reduce tax revenues and increase government deficit pressure. Rising unemployment increases government spending pressure. The fiscal position of European governments, already stretched by a decade of stimulus programs and the 2022 energy crisis response, deteriorates further, and deteriorating fiscal positions mean higher sovereign borrowing costs, which means higher interest rates throughout the European economy, regardless of what the ECB does with its policy rate. This is the spiral that the 1970s energy shocks produced. This is the spiral that is now re-engaging. The financial markets have already begun pricing it. This morning, March 24, 2026, the S&P 500 fell to 6,557, a 5.6% decline over the past month. The VIX fear gauge hit 27. The CNN Fear and Greed Index is at 15, a reading classified as extreme. Fear. European equity markets are underperforming even these already deteriorating benchmarks. The euro has weakened against the dollar as capital flows away from European assets toward dollar-denominated safe havens. This is not panic, this is pricing. The market is doing precisely what it is supposed to do, incorporating the available information about future economic conditions into current asset valuations. And the available information says that Europe is in the early stages of a stagflation episode with no clear exit mechanism and a central bank that has no good options. Now let me address the three objections people always raise at this point. The first objection is that Europe has strategic reserves that can bridge the supply gap, that the IEA's release of 400 million barrels from emergency stockpiles will cover the shortfall until the strait reopens. 400 million barrels sounds like an enormous number. It is 40 days of global consumption at current rates of supply disruption, with 200 million barrels already stranded in the Persian Gulf. The strategic reserve release is a bridge, not a solution. It buys time, and the price of that time is that when the crisis resolves, if it resolves, Europe's strategic reserves will be at their lowest levels in decades, leaving the continent more vulnerable to the next shock than it was before this one. The second objection is that the Strait of Hormuz will reopen soon, that diplomatic channels through Qatar, through Egypt, through back-channel intermediaries will produce a face-saving formula that allows both the United States and Iran to claim partial victory and resume energy transit. This may happen. The geopolitical seesaw is swinging daily. Yesterday, oil fell on peace rumors. This morning, it rose 4% as Tehran publicly denied those same rumors. The pattern of on-again, off-again signals is characteristic of negotiations that are happening but have not yet produced a resolution. The resolution, if it comes, will not come fast enough to prevent the economic damage that is already accumulating in European manufacturing and consumer spending. The PMI data released this morning reflects conditions in early and mid-March before the full force of the energy shock has worked through corporate cost structures and consumer behavior. The Q1 earnings reports, which will begin releasing in April, will show the actual financial damage. By then, the ECB will have another policy meeting with worse data and fewer good options than it has today. The third objection is that European governments will step in with fiscal support, energy price caps, consumer subsidies, industrial support programs as they did in 2022. They did do that in 2022. It cost the major European governments an estimated €800 billion in combined fiscal support over 18 months. It prevented a complete economic collapse. It also added dramatically to sovereign debt levels that were already among the highest in the developed world. The fiscal space to repeat that response in 2026 is significantly smaller than it was in 2022. The political appetite for it in Germany, which is still processing the political consequences of its 2022 energy crisis response, and in France, which is already in recession and facing its own fiscal pressure, is significantly lower, and the mechanism of the support capping energy prices at government expense does not solve the supply problem. It transfers the cost from consumers and businesses to governments that are already borrowing at rates that are rising because of the same crisis they are trying to address with more borrowing. So what does this mean for your money, specifically starting today? First, understand that the euro is a structurally vulnerable currency in this environment. The ECB's inability to aggressively tighten to fight inflation because tightening would accelerate an already occurring recession means the real interest rate differential between the dollar and the euro is likely to widen when real interest rates are higher in the United States than in Europe. Capital flows from euro-denominated assets to dollar-denominated assets. The euro weakens. Euro-denominated assets, European stocks, European bonds, European real estate held by non-European investors lose value in dollar terms even before you account for the deteriorating economic fundamentals underneath them. Second, understand the specific European sectors that are most exposed. German automotive Volkswagen, BMW, Mercedes-Benz faces the simultaneous pressure of high energy costs in manufacturing, weakening domestic consumer demand, intensifying Chinese EV competition in their key Asian export markets. European chemicals BASF, Solvay, Evonik face energy cost structures that make them uncompetitive against American and Middle Eastern producers with access to cheaper energy. European airlines Lufthansa, Air France, KLM, EO face aviation fuel costs that are now among the highest in airline operating history. If you have exposure to European equity through index funds or ETFs, understand what is inside them. The sectoral exposure is significantly more concentrated in energy-intensive industries than the broad index number suggests. Third, recognize what this means for the broader global economy. Europe is the United States' largest trading partner. Total trade between the US and EU exceeds $1 trillion annually. When European consumers stop buying because their energy bills have consumed their discretionary income, American exporters feel it. When European manufacturers cut production because their energy costs have made production unprofitable, the global supply chains those manufacturers are embedded in feel it. The S&P 500 is already pricing some of this at 6,557 today, down 5.6% in a month. The U.S. market is not yet fully pricing a European recession scenario. If France deepens its contraction and Germany follows in Q2, the repricing has further to go. Fourth, look at what is working in this environment and understand why. Defense contractors Lockheed Martin up 38% year-to-date. RTX near all-time highs are benefiting from the structural increase in defense spending that every NATO member is now committed to, regardless of how the Iran crisis resolves. The underlying driver is not the specific conflict. It is the recognition forced by events that European and American military readiness had been allowed to deteriorate to levels incompatible with the security environment that now exists. That spending increase is not going to reverse when the strait reopens. It will continue for a decade. US Energy producers ExxonMobil and Chevron, both up over 30% in 2026, are benefiting from the oil price premium while being insulated from the supply disruption because US domestic production is protected from Hormuz transit risk. American natural gas producers are in a specific category of their own, as this morning's reporting confirmed. U.S. Henry Hub natural gas prices remain remarkably stable between $3.10 and $3.80 per MM2, while European and Asian gas prices have skyrocketed. The U.S., with its shale gas abundance and logistical ceiling on export capacity, is an island of energy stability in a world experiencing its worst energy supply crisis since the 1970s. Companies exposed to US domestic energy production and the infrastructure of exporting that advantage. LNG terminal operators, pipeline companies, equipment manufacturers are structurally positioned on the right side of the energy fragmentation that is now permanently reshaping global markets. Fifth, think about the political consequences of stagflation in Europe. This is the dimension that almost no financial analysis is currently capturing. The 1970s stagflation did not just produce economic damage, it produced political transformation. In the UK, it ended the post-war Keynesian consensus and produced Thatcherism. In France, it accelerated the decline of the centrist establishment and empowered both the left and the nationalist right. In Germany, it reinforced the political primacy of monetary stability in a way that still shapes German policy today. The political parties currently governing France, Germany, and the EU institutions in Brussels entered 2026 with approval ratings already under pressure from a decade of economic stress, immigration debates, and post-COVID disillusionment. A stagflation episode where prices rise while jobs disappear and governments appear helpless is the most politically destabilizing economic environment that exists. The parties that are currently in opposition in every major European country are the parties arguing that the existing economic and institutional arrangements have failed. A summer of high energy bills, rising unemployment, and ECB paralysis will be their most powerful argument. What that means for European policy coherence, for the unity of the EU project, for defense spending commitments, for trade policy coordination with the United States is a second-order consequence that is not currently priced into any market. Here is the bottom line. France is in recession. Germany is on the edge. The Eurozone composite PMI is at a 10-month low and falling. The ECB has officially forecast stagflation below 1% growth with above-target inflation for 2026. The Strait of Hormuz remains effectively closed with 95% of normal tanker traffic still at a standstill. Trump has issued a 5-day extension to his previous 48-hour ultimatum. Iran publicly denied peace negotiations this morning, sending oil back up 4% to $104. The three historical precedents for this exact scenario, 1973, 1979, and 2022, all produced severe economic damage across Europe. The 1973 shock produced a decade of stagflation. The 1979 shock produced the permanent deindustrialization of British manufacturing. The 2022 shock produced €800 billion in emergency fiscal support and still damaged European industrial competitiveness permanently. This shock is arriving at a moment when strategic reserves are lower than in any of those previous episodes. Fiscal space is tighter, central bank credibility is more constrained, and the political systems are more fragile. The pattern does not care about optimism. It does not respond to confidence-building statements from ECB presidents or diplomatic communiques from Qatar. It responds to energy flows, and right now the energy is not flowing. The people who saw the 1973 shock for what it was, not a temporary political disruption but a structural exposure built over decades, finally being tested and positioned accordingly. They navigated that decade in ways that preserved and grew their wealth. The people who believed the shock would resolve quickly and that European institutions would manage it without severe consequences. They experienced a decade of real purchasing power erosion that no nominal return could fully compensate. The data is the data, the pattern is the pattern, and the PMI numbers released this morning are not the end of the story. They are chapter one of a story whose later chapters are being written right now in the decisions being made or not made in the Strait of Hormuz. Subscribe now, because the next video tracks this in real time. We break down exactly what the Q1 European corporate earnings reports, which begin releasing in April, will reveal about the actual financial damage already done. We look at which European companies have hedged their energy exposure and which have not, and we examine what the 1973 and 1979 precedents show about how long stagflation episodes last once they become embedded in wage and price expectations. The pattern does not need your permission. It does not require your awareness. France is already in it. Germany is next.